In this presentation, we will work a problem related to sales mix. We're going to have our information up top. We'll enter that information into our worksheet down below. Information up top is already in Excel. Note that if you're working a problem in a book problem or a problem in your business, you're going to want to put that information typically in terms of the top portion of Excel where you have the words, you have the numbers broken out into separate areas so that you can refer back to the data up top. That's going to be the most efficient way to set up your worksheets. We're going to use the pre-formatted worksheet in this example. Our data up top, we've got product A, product B. We've got the selling price per unit, variable cost per unit, contribution margin, then subtracting those two out. We have the machine hours to produce a unit, which is going to be 0.4 and 1 machine hour. That's going to be what we're going to be measuring in terms of. That's going to be our restraint cost or our limiting factors, the machine hours. And then we have the maximum unit sales per month is going to be 550 and 200, meaning this is how many we could sell max. We think this is our maximum sales that we could have demand for, 550, 200. Then we have hours of operating per day. We're going to say that there's 8 hours of operations. Working days in a month. We're going to say that there's 22 working days in the month. Operations, we have an option to increase. If there's an option to increase, then we're going to say that there's going to be another 8 hours of increase per day, and the fixed costs would increase to 9,000 with relation to that option. Okay, so that's going to be our data. We're going to start with the contribution margin per machine hour. So we're going to say, all right, because remember that the machine hours is going to be our restraint here. So machine hours, we have the machine hours used for A and B. So we want to get the contribution margin per machine hours in order to see what our appropriate sales mix should be. So we're going to say, all right, we're going to say that this is going to be equal to the contribution margin per unit, which is going to be this item up top. We said that this equals the 90. And this equals the 72. And then we want to take into consideration our machine hours. Now note our machine hours are less than an hour here. So the calculations will look a little bit different if you're talking about something that takes less than an hour or more than an hour. So just note that as you work these problems, just be aware that if you work a problem where it's less than an hour, it might look a little bit different than if you work a problem where it takes multiple hours to produce a unit of inventory. So in any case, we're going to say this is going to be equal to the machine hours, and the machine hours are going to take 0.4 for A, so this equals 0.4, and this is going to be equal to 1. Note the difference in formatting of the cell here. I've added decimals that are already formatted because we're using a pre-formatted worksheet here. If you're working this from scratch, you're going to have to decide, do you want to add decimals all the time? Do you want to put the decimals in only when necessary? Here we're putting the decimals in basically when they're necessary. That's going to give us the contribution hour per machine hour. So contribution margin per machine hour, which is going to be equal to the 90 contribution margin per unit divided by the 0.4 machine hours per item product. So that's going to be the 225. And again, of course, this number is going to be higher than the contribution margin per unit because it's less than 1. It takes less than 1 machine hour. If it took more, then you'd have a number that comes out to be less than here. So we're going to say this equals the 72, and this is 1, so it's just going to equal, of course, the 72. Now what we're going to do is we're going to take our maximum units per month and consider the hours to produce those maximum units. How many hours would it take to produce the max? In other words, we're going to say this equals the maximum units that we could sell, the demand that we have. If we could meet the demand, we would be selling 550 and 200. How many machine hours would it take to do that, right? That's what we want to figure. We want to say, do we have enough machine hours to just basically produce what we think we could sell? We're going to say, all right, the machine hours to do that would be the 550 times the 0.4, which would be 220 machine hours, and these items would be the 200 times the 1 machine hour. So that would be a total of 420 machine hours. Now, we don't have that many machine hours. That's going to be our constraint. We're not going to be able to put in 420 machine hours the way we currently have it. What we currently have is 8 hours times 22, or 176 machine hours. So given that, unless we go unless we increase our production, if we give that restraint, then what are we going to do? What's going to be our sales mix based on this information? How much of each unit should we use, given our restraint of the machine hours? So to figure that out, we're going to say hours. We're going to give our hours dedicated to production. And note that the higher contribution margin per machine hours is going to be for product A. So we're going to max out product A as much as we can, whatever we think is going to be demanded. So we're going to max out product A to up to 220 units because there's a higher contribution margin per machine hour for product A. And then if there's any left over, then we'll go to product B. In this case, we're going to use it all up basically in product A, and we're going to allocate the full 176, which is going to be equal to the 8 times the 22. Now, because that's our maximum hours and it's less than the demand hours that are needed for A in order to produce what would be demanded. So that means we're going to apply it all to basically A. So the total is just going to be applied to the A. And that's going to be our total hours. The units that we're going to produce then, this is going to be equal to the 176 hours that we have divided by the number of hours, which is 0.4 hours per unit. And that's going to mean that we could produce 440, which of course, again, is less than the max. That's why we're going to basically produce all in unit A, because we're constricted by the maximum. So then we're going to have our contribution margin per unit. So this is going to be equal to the contribution margin. Contribution margin per unit is going to be this item. And this is going to be equal to 90. So we have, and again, why is this the case? Because this is the number of units. Now we're going to our contribution margin, and that's going to give us our total contribution margin. So the contribution margin per unit times the number of units we're going to produce equals the 440 times the 90. That's going to give us the 39.6. And if we sum that up, of course, we're going to have the 39.6. In other words, we're going to produce all product A because that's where our higher contribution margin per machine hour will be. We'll consider the scenario of what would happen if we increase the number of hours by 8 hours per day. So if we had another 8 hours per day, and then that would have the same working days of 22 in the month, what would happen in that scenario? So we're going to have our new table here. We're going to say hours dedicated to production, the hours that we're going to put to production of unit A and B. We're going to put everything we can to A up to the point that we're going to max it out. Again, we're going to max out A as much as possible. That's going to be equivalent to the 220 hours because we think the demand is 550. So we're going to put 220 hours here. Now, we might want to work this backwards now and think, well, how many hours do we have? What are the total hours? Total hours are going to be equal to the 8 hours plus the 8 hours. I'm going to put brackets around that. So because we want to do that first, I'm going to bracket the 8 and the 8, which is 16, of course, times the 22 days. And that'll give us the total hours we have available. So 16 times the 22 days. That means that product B is going to get the difference, right? Whatever other hours we have is going to be the 352 minus the 220, and that gives us the 132. So then what's going to be the units that are going to be produced for the best sales mix that we have? Well, if we have 220 hours for A, we're going to say it's going to be 220 divided by the time it takes, 0.4. And that's going to give us the 550, the max that we believe we can sell. Product B is going to be 132 divided by the hours, which is only 1. So that it's going to be the same number because it takes exactly 1 hour. And I'm not going to the total is meaningless there. I'm not going to sum it up. And that's now we're going to say the contribution margin per unit is going to be equal to, that's going to be the contribution margin per unit is 90 and 72. And that'll give us the total contribution margin added. So we're going to say this equals the 550 times the 90. This equals the 132 times the 72. So our total contribution margin under this new scenario is going to be the 59,004. Now, if we look at the total contribution margin prior to this and make a comparison, we're going to say here's the prior contribution margin that we had. This is going to be equal to the 39.6. We'll take the difference between those two. That's going to be the change. This equals the 59,004 minus the 39.6, 19,404. So we have a higher contribution margin, but of course we also had to increase the fixed costs. So we had a change in the fixed costs to consider whether this is going to be a good thing to do. Change in the fixed costs is going to be equal to, and we're going to say 9,000. So if we subtract those two out, we're going to say that the change in operating income is going to be equal to the 19,404 minus the 9,000. So it's a 10,404, and that's going to be an increase. So the end number that we're going to come to, the total incremental income, is going to be equal to the 39,600 plus the 10,404 for a 50,004. And that, of course, is the prior total contribution margin plus the change that's going to happen here. So the change, the difference, the change that's happened is the 10,404, and that gives us the 50,004. So again, we got the total contribution margin for the new scenario, and that doesn't take into account the fixed costs. We then subtracted out the contribution margin prior to that, which gave us the 19,404. And then we took into account the change in the fixed costs, giving us the change in the operating income, 10,404. We took then the prior, where we were before, the prior contribution margin plus the total incremental income, the change amount here, and that's going to give us the total incremental income. So then the question is, should we add the hours, given the fact that the fixed costs will go up, but will increase the sales? And the answer is yes. It's going to be a benefit. We have a 10,404 increase. Now, if we add one more scenario to this, we could say, well, what if we can increase A's sales? What if we do some advertising, possibly? We put 8,000 into advertising, and because A has a higher contribution margin per machine hour, maybe it would be worthwhile to increase the advertising, increase in the sales, and then increase the number of units for A to 600 more units, so to 600 units. So let's say that's the case. So prior to this, again, if we go up top, we were saying that we can max out the sales of 550. So max units of sales for 550 for A. And now we're saying, well, we can max it out at 600 if we put some advertising into that of 8,000, and then we would be selling basically our more profitable units per machine hour. So let's run that scenario. Let's say, all right, well, the units of production is going to be 600 for A. The machine hours per unit, we're going to say, is equal to the 0.4. So there's our 0.4. That's going to give us our hours. So we're going to say the hours per product, because we're going to apply to A first, is going to be the 600 times the 0.4. So we're going to say 240 hours per product that we're going to have for product A. And then product B, we're going to allocate the rest of the hours that we have. So again, we're going to say this is equal to, if I scroll back up, it's the same total, the 352 from the prior time. And again, that of course is the 8 and 8, 16 times 22. That's the total hours that we have available. If we subtract those two out, we're going to say, all right, 352 is what we have. We're going to apply everything to A first, which is the 240. So that's going to say that we're going to apply 112 to product B then. So then we're going to say, all right, then the units produced for the best mix is going to be equal to the 240 hours, obviously, divided by 4.4, which is going to give us that same 600, right? Because that's what we figured in the first place. So then the 12 is going to be 112 divided by the number of hours that it takes 1 hour. We said 1 hour, so that's going to be the 112, and we'll keep that there. And then the next item is going to be the contribution margin per unit. So the contribution margin per unit is going to be equal to, that's given up top, the 90, and this equals the up top, the 72. So then we're going to multiply that out. So we've got the 600 times the 90, and this equals the 112 times the 72. We go ahead and underline this item. I'm going to go to the Home tab font and underline that. Do a little bit formatting here. They'll probably be formatted for you already. So this is going to be the total contribution for the added hours, or the total contribution under this scenario, the added cost. We're going to say this is going to be this 62,064. And then we're going to compare that to the prior scenario, this scenario where we had the added hours but not the added cost. So we're going to say, all right, what's the contribution margin prior to this? It's going to be the 59,004 contribution margin. And the difference between those two is going to be the change. So we're going to say the change in the contribution margin is going to be the 62,064 minus the 59,004. That's going to be the 3,060. Now, the only added cost that's a difference between these two items is going to be the added fixed costs, right? Because again, this fixed cost up here was added, the fixed cost was added under this scenario. The change is going to be this 8,000 added fixed cost. So we're going to have this added fixed cost of the 8,000. So let's say this equals the 8,000. And so the change in operating income then is going to be the 3060, but then we're going to have to pay 8,000 to get it. So we got a negative change in operating income of 4940. So that's going to be not a good decision typically. So then the question, of course, is should we do this? I'm going to say no. This is not going to be a good decision typically because of that change.